Hi, I'm Sandra Koshel from KSM Group. Well, the end of the financial year, 30 June, is approaching fast. There are many things that you can do to reduce the amount of tax you have to pay to the tax office. Most of these need to be implemented before 30 June to be effective. It's too late afterwards. We work together with our clients to assess their expected tax position for this year and look at strategies that can be implemented to reduce their tax. So here's my top 10 tax saving tips. Are you in the right structure in order to pay the least amount of tax that you legally can, as well as protect your business and personal assets? So structure, I'm talking company, trust, partnership, sole trader, etc. This should be regularly reviewed to ensure it's still right for your current situation. Changes in tax laws are constant, and there may be significant advantages in having your business structure reviewed. Having the right structure can save you thousands in tax each and every year. Are you operating your business through a discretionary trust? These trusts don't pay tax themselves, but rather distribute the profit to their beneficiaries, who then pay tax on their amount if they have one. Do you know that if these trusts don't document this distribution before 30 June, the trust itself is then taxed at the highest rate, 45%. To get the distribution right in order to pay the least amount of tax, careful planning needs to be done. Wherever possible, defer your income to after 30 June and bring forward necessary expenditure and asset purchases to before 30 June. This will reduce the amount of tax payable in this financial year. Do a physical stock take and review your stock records at year end. Did you know that there are actually 3 different valuation methods that you can choose from to value your stock at year end? You can change the method from year to year, and choosing the right one can have a significant effect on your tax amount, so get advice on this. There's some great geared investments around that can give you good capital growth as well as deductible interest deductions before 30 June. A geared investment simply means that you borrow to invest, just like purchasing a rental property, and the interest is tax deductible. You can prepay the interest on these investments before 30 June and claim a full tax deduction. If you don't have the cash to prepay any interest before 30 June, it can be borrowed as part of the finance, so you can still get the deduction this year. Now, these investments need to be looked at by a qualified financial planner in conjunction with your entire financial situation, so seek advice to suit your personal situation. If you've got a rental property, you can also prepay interest on your loan before 30 June and get a full tax deduction. Insurance to cover your income if you get sick or injured is essential, and it's fully tax deductible, and paying your annual premium before 30 June can give you a full tax deduction this year. So if you're an SBE, that's a small business entity, your turnover is under 2 million per year, you can prepay next year's expenses before 30 June and claim the full amount as a tax deduction in this year. SBEs can also get deductions for asset purchases under a certain limit upfront and high depreciation rates on others. So if you need new cars, machinery, equipment, etc., get advice on whether you should do that before 30 June rather than after. Review who owes you money. You may be able to claim a tax deduction for any debtors that are now not recoverable as a bad debt deduction. Review how much cash you've taken out of your business during the year, because this cash can be treated as wages, directors' fees, dividends, drawings, or a loan to you. Each of these has very different tax effects on both your business and also yourself personally, so get advice on the best way to treat this. Superannuation is a great way to save tax. Let's look at some strategies. Any contributions into your super are taxed at 15%, whilst you can claim a tax deduction at the rate of the tax bracket you're in, so that's up to 45%. There are annual limits that apply and other conditions, so get advice. It can save you considerable tax while saving for your retirement in a low tax environment. If you've made a capital gain during this year on a property or some investment sales, you may be able to use a superannuation contribution to offset against the capital gain and so reduce your tax payable. If you have life insurance policies within your superannuation, the insurance premiums are tax deductible, whereas if they're held in your own name outside of super, they're not. So even though there are annual limits on how much you can get a tax deduction for on your super contributions, did you know that there is actually no limit on how much you can put into your super? So get the right advice, as moving your wealth into super over your lifetime can mean you pay no tax at all for the remainder of your life in retirement. So now's the time to look at ways to save for this financial year that we're in before 30 June. Remember, failing to plan is planning to fail.